John Winnie, President, CEO, Clark Street Capital is our special guest. John, welcome.
Thank you, Bob.
In
Great to be here.
October of 2008, at the height of the financial crisis, John had the courage and vision to start his firm, leaving his career as a bank executive. John, I don't know if I would say that was courage and vision to start in 2008, but congratulations, you've done very well. Tell us what you do.
Yeah, so I appreciate that, Bob. I'm CEO of Clark Street Capital. I run a bank consulting advisory firm. Our preeminent source of revenue is the sale of whole loans, performing, sub-performing, non-performing. We're actually completing an SBA 504 sale right now. Started the firm in 2008, also do correspondent lending programs for banks and, valuation and due diligence on portfolios.
How do the mergers yesterday, tell us who merged with who, affect the people on the call today who are underwriters, primarily SBA 7(a) underwriters?
Yeah, let me just talk about the general economy, and I'll sort of touch on that. It's sad. It's a sad, sad day. In one full sweep, in one day, the number of choices for commercial and consumer customers in the states of Michigan and Ohio particularly just got a lot smaller. And, where I see opportunities for SBA lenders, I'll talk about in a second, but I think the real negative is for the middle market firm that has, $10 to $50 million in borrowing needs. You just removed a significant competitor in each of those states. And I haven't looked at the numbers, but I think, when you start looking at Michigan, Ohio, it's going to start to resemble a state like Utah, where essentially you have got your big banks, you've got Zions, and virtually nobody over $1 billion in assets. So it's a real sort of barbell type situation where you're either dealing with the large bank or you're dealing with the small bank. With respect to SBA lenders, no question, disruptions and mergers often result in a divestiture of certain relationships within a bank. Most likely, there'll be customers that'll want to leave. They'll be unhappy with the level of service. A merger is incredibly disruptive to the people, and during that, 1.5 year period, there's a lot of time is being spent dealing on internal matters instead of focusing on the customer.
Yeah, and I assume this is a trend that's going to continue in our industry of consolidation, correct?
Well, I remember when there was 8,000 banks, and this was at the height of the crisis, and the talk was thousands of banks would fail and so on. And while they didn't fail, we probably had 600 bank failures. We were down to about 5,800, right, which is, pretty significant. And a lot of people are saying that this year will be the biggest year of bank mergers in history, at least as far as number of deals.
John, we have SBA 7(a) underwriters on the line. You're an expert in the secondary market. It's been all-time high. What do you see for the outlook in 2016?
I think that strong. I think that there seems to be unlimited demand for the guaranteed paper. On the 504 secondary market, we have been playing an important role in kind of getting that going again by doing quarterly sales of 504 portfolios. We expect to market, in the neighborhood of 50 to 100 million of 504 forced mortgages this year. And, one thing we're finding is we are broadening the audience. We are selling 504 loans at premiums to players that, no one's really ever heard of. And, in some cases, these were banks that previously had sold 504 loans at a premium and are now buying them at a premium.
What's a run-of-the-mill premium for 504? Average, typical deal, run-of-the-mill.
Yeah, I think a safe range is probably 103 to 105, depending on the coupon, prepayment penalty.
Yeah.
You could certainly justify 108 to 110 type premiums, but there's sort of a skittish factor. It's just hard psychologically for a bank to pay out 8 points on a $4 million deal.
I understand. It's a lot of money. John, we have, as I've said for the third time now, underwriters. If I'm an underwriter, how does this new FASB rule and loan loss affect me personally? First of all, tell me what everyone's talking about, and how does that trickle down to the individual underwriter?
Yeah, I mean, I think what's most important about this, well, there's two things that are important that are notable. One, it's going to happen. Okay, there's this chatter that the ICBA is having a big powwow with the FASB folks, and they're going to have some kumbaya session and agree to drop all this nonsense. That's not going to happen. I mean, it's going to happen.
John,
the regulators are behind.
Yeah, John, take a step back. Assume there's someone who doesn't know what we're talking about. What are we talking about?
Yeah, so basically in the past, banks, the current model for losses on loans is based on what's called a incurred or realized loss. So a bank doesn't take the specific impairment on a credit until there's actually been evidence that there's going to be loss taken. The problem with that approach is it's very backwards looking, and it causes massive disruptions, as it took the banks 2 years probably to get caught up with the defaults in their portfolio. So regulators said, let's go to a different model. Let's go to the current CECL proposed model. And the difference in the model is it's realized loss versus expected loss. So basically what you're going to have to do is build a model and project what your losses are going to be on a segment of loans. So I assume you would do that on your SBA portfolio. I'm not sure if it would be granular by SIC code, but that's certainly something that's a possibility. Project your future losses. It's going to make SBA loans less attractive on some level because the terms are generally longer than regular loans. And, clearly the longer the term is, the more likely there's going to be a default in the future because you're taking 20 years of risk versus, say, 5. That's very controversial. And the other big thing I want to say about this is we don't know what these models are going to look like.
Right.
And we don't know if Bank A can use one model, Bank B can use another. We're actually working with a few folks and helping to develop a model like this. But there's almost been no guidance from the banking agencies as to how this is going to work. What you need to know is this is going to happen. It's going to affect maturity on loans, and
and when you
sit
book
back
a
and
loan,
wait to what the details look like.
When you book a loan, you're going to have to make an accounting entry to book the anticipated loss or reserve right up front.
Right. It's. I would prefer if they just went to a mark-to-market approach for all assets. I think that could be done on a. It makes more sense. This is really going to hurt maturities. That's the thing that bothers me about this. Is it's going to encourage everybody to do as short a maturity as possible.
Or maybe even a call function.
I'm not sure that's so good for.
Yeah.
I'm not sure that's so good for borrowers.
John Winnick, CEO, Clark Street Capital. John, thank you very much for joining us. I appreciate your time, John.
You're welcome. Thanks for having me.
Thanks a lot, John.